So I think patience for pricing. I mean, as deep value investors, we believe that price is the ultimate gateway to returns, right? We think price rules. So better to have the opportunity cost of having money not invested and wait for a fat pitch. I would say that's, and I think when you're managing other people's money and you have pressure to put money to work, I think it takes real strength to basically watch money go out the door because you're not investing it. Now, in our case, we have, 70% plus of our net worth invested in our securities. So we are having so much of our own wealth on the line, we're not going to invest in anything that doesn't make a tremendous amount of sense to us. The other thing I would say as deep value is I really think people need to get out of the office more. I think they need to go and visit operations. I think they need to talk to customers. They need to talk to competitors. I'm always surprised often when I talk to either an analyst or investor, how many customers have you spoken to? What are competitors saying? I really think that deep value investors in particular have to bring a really kind of investigative journalist type mentality to get to the bottom of the stories, because these things are often so you've got sentiment changes, you've got industries in bear markets, but let's face it, a lot of these things are depressed because there's fear, and you have to understand what the source of that fear is, and you really kind of get to the bottom of it to determine whether the security is mispriced. And it's a beautiful moment, by the way, when you really kind of get and understand why this thing is mispriced and why it's noise and not a signal. I mean, it's just a great feeling. The other thing I would mention in terms of sizing how we as deep value investors add value in a world that seems to be increasingly going toward indexing. I mentioned the self-study that we regularly do. One of the things that we learned is we have a much higher success rate with our high conviction ideas. So of all the equity investments we've made in the last 16 years, 2/3 of them have been successful. And with an average annualized return of 19%, including the winners and the 1/3 losers. But when you go to those securities where we allocated at least 5% of capital to, what we call high conviction ideas, our success rate goes from 2/3 to 85%. And our average annualized return on the whole set, the 85 and the 15% that lost and the 5% or greater, goes to 25%. So, and that's something that we have really paid more attention to, is allocating more capital to high conviction ideas. We do so much work on these things that we have left money on the table by not allocating sufficiently to really high conviction ideas. And so I think when you really get to the bottom of a story, and I would say again, I wouldn't recommend personally you take big positions in leveraged securities. If you take a 1% bet for a 7-to-1, 5-to-1, okay, that's one thing. But we can confidently average down in unleveraged securities of businesses that we understand with multiple shots on goal. So stick to strong balance sheets, stick with people you get to know and you understand what their motivations are and kind of who they are to the greatest extent possible. Put more capital into your best ideas after doing a lot of work in your own detective work.